Just imagine, you wake up, brew yourself your favorite coffee, start logging into your banking app, yet somehow everything seems off. And then it hits you, your account was blocked. Thinking clearly is gone, welcome panic. What to do? Assemble your gang and storm the bank? Since having your account blocked is any company's nightmare. God forbid that was the only account. While you are trying to sort this out, you're losing money and business potential. All of a sudden, everything is stuck. But having your account blocked is not a dead end though, just a crisis to be overcome. Which is why today we're going to look into the background of account block, ways to tackle it, and how to keep your poise in the future. This is Marcel from Garant Business Consultancy. Let's get busy. Nowadays, banks run their entire backend automatically. They are constantly improving, testing the limits of what is possible. Like K9s at customs, these systems sniff out anything out of the ordinary and highlight if it's necessary. If your activity becomes atypical, for example, since banks conduct due diligence on customers as they open accounts to build a profile of your operations, where they dig into your business, how many transactions, what's the forecast, where are you operating. They'll even check your partner's websites. All this info gets siphoned into a profile. That's the baseline the system uses to keep an eye on things. So if all of a sudden you're buying from China, previously not declared in KYC, or transactions are double the usual amount, the bank system is definitely going to notice and take action. Most of the time, this happens for several reasons. The first reason is cash deposits. Pretty straightforward, depositing cash into your account. In all fairness, banks are no big fans of cash deposits, since it is difficult to trace their origins, basically marking cash deposits as high-risk transactions. There is no clear one rule fits all here. Whether you get questions about deposits or not, you just got to know your way around. Many people prefer depositing cash through ATMs. It is quick and convenient. However, this can raise some alarms with the bank, which may request information about the source of the funds. If you fail to provide the details on time, your account might be frozen. On the other hand, if you make a cash deposit directly at the branch, the bank will usually ask for necessary information right away. Things like your account details, contracts, and etc. In some ways, going through the branch is less risky. When you deposit cash in person, the bank already has some idea of what you are doing, so they're less likely to freeze your account unnecessarily. Another reason your account might get pinched is receiving a transfer from a company that was not declared during your KYC collection. That will leave many cosplaying De Niro's taxi driver.
You talking to me?
We'll get to black and gray list in a moment, but for the sake of this example, if it's a high-risk jurisdiction, say a company from somewhere in North Africa. But instead of simple questions, the bank might have other concerns. Naturally, this does not happen every time. Companies grow and expand, and everyone understands that. But in some cases, the bank may still inquire about particular transactions. That said, I want to emphasize that it's not just official lists that matter here. Internal protocols also play a significant role in how banks operate, and these rules can vary widely from bank to bank. Let's start with official lists first. Just like in Harry Potter, in simple terms, Gryffindor, the good guys, Slytherin, the troublemakers, and no one really wants to be in Hufflepuff. It's a similar situation here. There is the Financial Action Task Force, also known as FATF, the sorting hat. It fights money laundering and terrorism financing. FATF standards require countries and financial institutions to implement effective AML systems, like due diligence, transaction monitoring, and mandatory reporting of suspicious activities. Recently, FATF even dipped its toes into crypto. Thanks to the organization, there are three key lists. The white list is for the good guys, the Gryffindors. The black list includes countries that do not comply with international standards, for example, North Korea. Largely because of its nuclear program. Iran is also on that list, but you can work with that. However, you can work with this country under certain conditions. No wonder it's a geopolitical leader. Then there is Myanmar, home to old Bagan. Just look at these magical landscapes. But despite its beauty, FATF remains firm. By the way, Russia is not on either the black or grey list, though its membership has been suspended. The grey list includes countries that are taking steps to combat financial crimes, but are not meeting international standards yet. There are quite a few here, over 20 in fact. Some notable ones are Syria, Bulgaria, Croatia, Lebanon and Monaco. Even the Philippines, Venezuela and South Africa are on that list. So if you are doing business with these countries, banks will pay extra attention to your transactions, with problems showing their ugly head later down in the line. Actually, AML is not just for banks, it also applies to companies in many industries. For example, finance, brokers, or the non-financial insurance, legal and audit, collectively known as Designated Non-Financial Business and Professions, DNFBP. But we will get to that next time. The third reason for a freeze is a tricky one. It happens when a company sends money to an individual who is not officially connected to it. If you are paying your regular employees, no big deal, the bank gets it. The message is crystal clear, this is salaries, bonuses, whatever. But sometimes companies send money to random beneficiaries, an undisclosed owner for example. Sure, they might label the transfer as a loan repayment, services paid, or even mention the contract number for a good measure. That is smart and that helps, but guess what, the bank still raises the concerns. Why? Because banks do not enjoy seeing businesses sending cash to random beneficiaries, especially if those folks do not have any logical links to the company from the bank's point of view. It then puts the transaction in the spotlight and asks for the proof of explanation. Think of it as that strict teacher who always wants you to show your work. And if you do not get it in fast enough, then the joke is on you. They might block your account faster than you can say cash flow crisis. The fourth reason for a freeze is a change in your risk level. Picture this. You have done everything right, registered your business and opened an account. Time for a pat on the back. After that, the bank runs something called risk assessment. It is a system they use to evaluate clients and assign a risk profile. This tells them how safe you are as a customer when it comes to financial operations. For example, let's say you're a small IT company working with local customers. Clearly, your risk level would be pretty low, let's say a 3 out of 10. But if, out of nowhere, your company starts acting very differently, for example, does something that raises the risk level to 10, like providing services to a crypto company, in this pickle, the bank might become suspicious, shut down your account and put your company on a list. It's not the end of the world, definitely not as bad as waking up next to a horse head. This might lead to being put on a list. It is like a red flag that sticks to your profile in the system. And depending on how serious it gets, it could cling on within the bank or its network, or escalate all the way to the central bank. If that happens, there is a good chance you'll end up on a sanction list. So when does this actually happen and how can you avoid it? Welcome account block reason 5. Not vetting your clients. If someone sends you money, you have to do your homework first. This is called due diligence. Before accepting payment from a client, stop and ask yourself, who exactly am I dealing with here? Are they shady? Is the police looking for them? I might be exaggerating here, but stranger things have happened. Here's a kicker, even if you work with someone for years, you cannot just assume they are squeaky clean. You need ongoing screening. Think of it as constant surveillance. Why? Because people change. A client who was legit yesterday could show up on a high risk list tomorrow, and if that happens, you are toast. You did no wrong and now you are being dragged into a mess because of the butterfly effect. Let's bring it back to our IT company example. What happens if one of your clients suddenly ends up on a sanction list? The best move here is to cut all ties immediately. Their activities might be carrying sky-high risks, and standing close will only make you a collateral damage. To keep your business safe, internal risk scoring is not just smart, it is essential. You need to know who is safe to work with and who is trouble waiting to happen. This way, you protect yourself and sidestep unnecessary drama. We've got through key reasons. Now let's talk about freeze actually taking place. What is your first move right after? Step 1. Take a deep breath and chill. The sky isn't fallen yet. This is where you channel your inner Ryan Gosling. Stay cool, collected and focused. Your mission? Figure out why the account was flagged. Faster you crack what sets off those alarms, the quicker you can fix it. Important emails might get buried in spam and overlooked entirely. So take a step back. Here's the deal. Banks are watching how you handle compliance requests, and your behavior matters a lot. Think the snake characters. Be positive, cooperative, and rock-solid professional. Whatever you do, do not be yelling at the bank for asking questions. Attack is definitely not the best defense here. Putting documents together is the second step to unlocking your account. Review the list of requirements and any additional information in the initial request from the bank. As a rule, this list has already been prepared and sent via registered email in your profile. If you cannot find the email, you can always contact your personal account manager or bank support service. Important to remember, These documents will serve as evidence of your integrity. If you see anything you do not understand, ask for clarifications. Sometimes it is the caveats of a phrase or certain specifics of your business. However, banks usually request financial reports, contracts, invoices, and other documents that confirm the legality and rationality of your business transactions. Leave all that catch me if you can type stuff out of the door. It is very important to respond to all the requests as quickly, clearly, and accurately as possible. The third step is to carefully do what they require. This ensures you do not submit incomplete or incorrect documents that could slow down the process. Why is this important? Well, if you start hiding stuff or dragging your feet, it can trigger specific protocol to the central bank, particularly the Financial Intelligence Unit, also known as FIU, a group that monitors activity 24/7. Clearly, nobody needs this. Now, on the bright side, this is usually the final stage. On the downside, you might end up with another label or even land on the more serious lists. So, do not take offense, do not ignore text or emails from the bank, and under no circumstances file them away with promotional offers. If you are missing certain documents or need extra time to gather them, be sure to explain the reasons clearly. Step 4. Keep in mind that banks have a clock that they get stick to. There is a predetermined amount of time to figure out what is going on with your account. Often, if everything seems like it's smooth sailing from here, stuff can still go sideways. If you drag your feet or take too long to respond to their requests, the bank might not hit its deadlines. And when that happens, chances are your account is going to stay closed. Houston, we have a problem. Again, step number 5. Show them the yellow brick road. Think of a bank as a detective. They want to know where the money came from, where it went, and why all this is happening in the first place. What will make you sound in charge of the situation is the grasp on the documents you gathered from the list. Really, every transaction should be documented ahead of time. Everything needs to be crystal clear. Contract number, amount, dates, no nonsense, no hiding stuff. The bank is going to find out anyway, because that is literally their job. Contracts, logistics, documents, certificates, every step of the deal should be squared away, especially if you are dealing with the goods that might be considered suspicious. For example, dual-purpose goods. This mostly applies to trading companies. What exactly is a dual purpose? On one hand, it's a totally standard product. On the other hand, however, it can be used for something dangerous. Sometimes the difference between peaceful and dangerous is just a few letters away. For instance, microchips. You can use them in smartphones or weapon systems. Chemicals, great for pharmaceuticals, but also ingredients for explosives. Here's what the list of dual-purpose goods looks like. Get the full list in the description below. You can find the full list in cards. Financial institutions are required to follow international regulations, including FATF rules. Any hint that your transactions involve dual-purpose goods will make the bank uneasy. In other words, of a Superman's stepdad.
With great power comes great responsibility.
Dual purpose equals to dual responsibility. To put everything in perspective, the bank is like a teacher, strict but fair. If you start making excuses, getting confused, or hiding details, they will immediately think something's fishy here. That is why it is crucial to keep the conversation constructive. Banks do not freeze accounts for no reason. They have a cause. Your job is to figure out exactly what raised the red flag and address it. The key to success? Document everything. Invoices, acceptance reports, shipping papers, you name it. The faster you provide the documents and answers, the quicker the block gets lifted. Forewarned is forearmed. So how can you prepare for these kinds of situations in advance? Firstly, always have at least 2 active accounts running at any given time. If one starts giving you trouble, quickly open the third one. In other words, mitigate potential risks. There should always be 2 active accounts. Secondly, review your partners and clients. After all, they're your financial reflection in the eyes of the bank. Check for sanctions, criminal records, or outstanding debts. Conduct ongoing screening and due diligence. It's worth it. Thirdly, do not play around in the gray zone. If you work with high-risk jurisdictions, be prepared for extra scrutiny. It is just a part of the game. Fourth, keep an eye on cash deposits. It is safer to make them through a bank branch rather than ATMs, which reduces the chances of raising the red flags. Fifth, ensure your transactions are crystal clear, even to the robot monitoring your account. Transparency is the key. All this prep is basically insurance. When everything is smooth sailing, it might seem unnecessary, but the moment something goes wrong, you will thank yourself for being proactive. Do not wait for the bank to start asking questions, take the initiative. It is better to spend an hour preparing than eternity trying to unblock your account. Transparency, competence, and trust-based relationship with your financial institutions are the three musketeers standing guard over your business. With the right approach, we will be one of those musketeers. Garant Business Consultancy helps companies avoid costly mistakes. Click description below to get all the info. And also, let us know in the comments, have you ever dealt with the headache of a blocked account? How did it turn out, and how many gray hairs did it cost you? And this was Marcel, co-founder of Garant Business Consultancy. Until next time.